Hi everyone, good afternoon. Welcome back today for the syllabus webinar of the BILS. And as promised to you today, we have a wonderful speaker with us, a very well experienced solicitor practicing in corporate law since many years now, one of the best in the field, Mr. Sanjay Asher, partner of Crawford Bailey and Company. It will be wonderful to have him here today. Thank you, Sanjay, for being here at such a short notice and preparing yourself at such a short notice. And it's a pleasure to have you here today for our subject on Chapter 15 of the Companies Act 2013 on amalgamations, mergers, demergers. Uh, it is lovely to have you here today. And you can, I mean, Sanjay has been, he has been a solicitor practicing at Crawford Bailey since many years now and well known in this field. Everyone knows him. So I don't need to introduce him more. And Sanjay, you can take over. He's a very busy person, by the way. So thank you for taking out time for us. And I must appreciate that he has taken out time, especially at my request. So thank you so much, Sanjay.
Thank you, Nilesh, for your very kind words. They are very kind words, but they're not necessarily accurate. They may not be accurate words. Nilesh is a good friend, and I know him since the time they were in school. So you can well imagine as to how many years I know Nilesh from. Two, I don't attend the school get-together parties. I've only attended, I must admit, one or two. But Nilesh religiously attends all the parties. And then I get an update from him or a couple of other school friends who update me on what happens. And there is one particular friend who keeps telling me and who keeps requesting me, please come and show your face only once, at least. At least come for 5 minutes and then go away. Anyway, Nilesh is a good friend and therefore necessary. Thank you, Nilesh, for this opportunity. It will be a good revision for me as well in relation to the topic on Chapter 15 of the Companies Act 2013 on mergers, amalgamations, and reorganization. I would presume that the participants are all lawyers or are article clerk preparing for their exams for the solicitors. Is my understanding correct on that, Nilesh?
Yes. Most of them are like lawyers or article clerks.
Yeah, article clerk preparing for the exams of the solicitors.
Or even article clerks who would be due in future.
Fine. Who would be attending to the matters relating to amalgamations or mergers and demergers?
Yeah. So the idea is that we are recording this and then we'll be putting it on our website, the BILS website. So
I wish I would have known that, then I would have been better prepared.
No, it's fine.
If you had told me that you're going to put it on the website and all of that, then I would have said, I don't want to participate in this particular Zoom meeting. No, don't put it on the website or don't circulate it to the members as such.
Member, no, it's for article clerks. So they
no, but still let me have a look at what I talk. Okay. And then we may have to redact certain things if I talk some nonsense, and then one may be able to circulate that.
Okay, sure. No.
Okay, fine. So let's go straight away to chapter 15, which is the chapter which deals with the mergers and amalgamations. The topic, in a sense, is a very simple topic. At the same time, the topic is a slightly tricky topic, but at the same time, a topic which has a completely practical utility for a business person or a business house or a business entity. The reason why I say that the topic is particularly useful for a business house or for a business entity for its growth is that the business persons or a business house or a business entity uses this particular mechanism which is provided under the Companies Act for the purpose of acquisitions as well. Now one would say that why do you say that this particular chapter or the provisions which are there, which are embodied under 230 to 240 of the Companies Act, can be used for the purpose of acquisitions as well? Let me give you an example. If two large companies, company A, which is large, say with a market capitalization of say 100,000 crores, 1 lakh crores, and you have company B, which is almost the same size or maybe slightly smaller than this. So company B is a company which is say with a market capitalization of 75,000 odd crores. Now if company A has to acquire the majority shareholding of company B, a simple arithmetic would tell me to acquire a company with a market capitalization of 75,000 crores and 51% of that 75,000 crores would mean 37,500 crores. I pose myself a question. Is it worth spending cash worth 37,500 crore and pay to the shareholder who is controlling company B, whose business I want to acquire, and take it into my fold and spend 37,500 crores? Obvious answer to a lawyer would be, I don't think there is money to be wasted like this. To a businessman, he would say, yes, it does make sense, but I don't want to spend 37,500 crores. I would rather use this money for something else. In which event, what do? I tell the owner of company B that, look, let's merge your company with my company, which is company A, and then I will issue shares of the combined entity to you, with the result that A, you will get the benefit of a larger piece of cake, and the combined market capitalization of both these entities would obviously be bigger and not necessarily 100,000 plus 75,000, which aggregates to 175,000, but it would be much bigger for a simple reason that you are eliminating a competition or you are eliminating a competitor, and therefore you will get a better market share. Forget for the time being the implications under the Competition Act. We will come to Competition Act in a bit when we get into the detailed aspect of this particular topic. But with this mechanism of transferring the entire undertaking or merging company B into company A and issue the shares of the combined entity to the shareholders of company B would help the business to grow, will help the shareholders of company A because it acquired a business and therefore consequently increase in top line and increase in bottom line, and therefore more dividend and perhaps, or rather most of the times, better market capitalization. At the same time, all of you may also be familiar with the provisions of the SEBI Takeover Code, in short known as SAST. And I will, in this discussion today, have I will describe the Takeover Code as SAST provisions, regulations, or the Takeover Code. If I would have had to pay 37,500 crores, or if I acquire by paying cash more than 25%, I have to make an open offer to the minority shareholders or to the balance shareholders and acquire from them another 26%, which would mean that I will have to shell out another 18,875 crores of rupees. Question again I pose myself, is it worth spending 18,000 odd crores and pay to the minority shareholders merely because I have to comply with the provisions of SAST regulations? The obvious answer is no. You will be foolish if you spend that 18,800 crores just to acquire or just to comply with the provisions of SAST. And therefore, the provisions of 230 to 240 comes very handy to a businessman from the perspective of acquiring a business. So these provisions have been included to benefit business and commerce so that the businessman can acquire a company or a business in a very simple manner without spending too much of cash. At the same time, a win-win situation for both the company which is acquiring and its shareholders, as also the shareholders of the company whose shares are being acquired. And the means of this acquisition is not paying cash, but it is a cashless transaction whereby the shares are issued in exchange of the transfer of the entire undertaking of company B. Nilesh, are you there or you are gone? Let me, ladies and gentlemen, let me check with Nilesh as to whether the question answers, do we do it simultaneously whilst we are discussing this topic, or we keep it at the end? Because it may be better that if the question answers are also taken up just now.
But there are no questions just now, and we always do it at the end.
Okay, fine. I'll follow that discipline. If the questions are at the end, then I'll follow that discipline.
And they will put it on the chat. So I will just ask.
So I'll have to keep checking.
We don't have that interaction of they asking questions and all that.
Okay.
You can complete your talk and then we will see.
Fine. Okay.
Thanks.
Now I've explained you in theory as to the acquisition and the means of satisfying the consideration, or paying the consideration is a cashless transaction by issue of shares in exchange for acquisition of business. Let me now then put it in practical day life. Let's go 6-7 years behind. There is this company called Sun Pharmaceutical Limited. Large entity, large market capitalization, international business. They are in the business of generics, as all of us know, and they wanted to acquire a similar giant. And the giant was Ranbaxy Laboratories Limited, which also had a subsidiary entity, which was again a listed entity. Now, the value of that transaction was 25,000 odd crores. For anybody, a layman, a student, a lawyer, or a businessman. He would ask himself a question. If I want to eliminate a competitor, and if I want to acquire this particular business, how do I acquire this particular business without spending cash? The answer to that is that you propose to the majority shareholder that I'll acquire your business, and in exchange, you will get the shares of the combined entity. If it makes sense, business sense, then obviously it will certainly say yes, that this particular mode of acquisition is acceptable. I would say more often than not, or 9 out of 10 times, large transactions, whether in India or globally, do happen through the mechanism of amalgamation or merger, which would mean that the entire business undertaking is transferred to the transferee entity, and the transferee entity is being liquidated without being wound up. In other words, there is no winding up order, but at the same time, the transferor entity is liquidated. In other words, it is buried, and every single asset, every single liability, every single contract and license gets transferred to the transferee entity. I will come to the Companies Act aspect of it, which is the main topic for discussion today, in a minute, but I will also touch upon certain nuances with reference to certain businesses which require license, and where the terms of license or the license agreement or the condition of license mentions that, look, you require the approval of the licensor or the person who has provided you with the license for the purpose of amalgamation or for the purpose of merger. Immediate examples which come to my mind are telecommunication. Because there is spectrum which is involved, and therefore, if there is an overlap spectrum of transferor and transferee entity, in which event the regulator will say that of the two spectrums, you will have to surrender one of the two spectrums back to the ministry, and then only you can amalgamate. Another example which comes to my mind is insurance. Again, the Insurance Act of 1938 comes into play, where both for life and general insurance, whether it is acquisition or whether it is amalgamation, one has to obtain the approval of IRDA or the insurance regulator for the purpose of amalgamation. Let me give you another third example, which is NBFC, non-banking finance company, which are governed by the provisions of Reserve Bank of India 1934, as also there are special provisions which deal with the NBFC. Again, the regulator being RBI, which gives you license to carry on the NBFC business, approval and conditions of NBFC RBI Act have to comply with. Let me give you the fourth example, and I'll give you examples which are in day-to-day practical use. There may be other examples as well, but the 4 or 5 examples which immediately come to my mind is banking, insurance, telecom, NBFC. These 4 are the glaring example where the regulator also has a say in relation to the amalgamation or merger or demerger of any business entities. So in case of the banking regulation, the RBI is the regulator which has issued the banking license, and therefore the amalgamation of or merger of two banking entities is governed by the provisions of the Banking Regulation Act 1939, and the regulator has to grant you approval for the purpose of amalgamating or merging the two banks. Now, let's come back to the provisions of the Companies Act. Even under the previous statute, which is the Companies Act of 1956, what was defined was compromise or arrangement. And let me spend 1 minute on what the compromise or arrangement is and what was defined under the previous statute 391 to 394 of the Companies Act 1956, where the powers of sanctioning a scheme of amalgamation or merger or demerger was with the company court, which is the High Court, and there were company court rules which had to be followed for the purposes of the sanction of a scheme. Now, the term amalgamation or merger was not defined under the previous Companies Act under 391 to 394. What did it say? It says where a compromise or arrangement is proposed between a company and its creditors or any class of them, or between a company and its member or any class of them, the tribunal, of course, it was the court, may on application of the company, of any creditor or the member of the company, etc. And then it says as to the approval would be granted by the company court and the necessary approvals which are required from the shareholders or members of the company and the creditors or the creditors of the company. Nowhere in section 391 to 394 there was this definition of amalgamation of merger of the companies. Now, merger or amalgamation or demerger is one of the ways of compromise or arrangement between a company on one side and its member or creditors on the other side. So this was what was there in the old statutes. Now let us see as to what does the new statute or the 2013 statute speaks about the amalgamation and mergers or demergers of the entities. The provisions are more or less the same, except that now the National Company Law Tribunal is the authority which sanctions or which grants you the approval for the purpose of merger or demerger. And previously, under the old statute, it was the company court or the High Court which granted the approval for the purposes of mergers and demergers and amalgamations. Now, let's keep our today's discussion into three buckets. One, which is the fast track method, or where there is the 100% subsidiary of a company. The second one, where the merger between or a scheme of organization between two unlisted entities. And the third one, which is where either of the two entities or one of the entities is a listed entity. Let's take it in the reverse. Let's take the complicated one, or let's take the schemes of compromise or arrangement where one of the entity is a listed entity. What happens in that? So in which event you have the SEBI or the Securities Law Authority regulator also coming into play. Now, as we may be all aware that previously under the Securities Contract Regulation Act of 1956, every company whose shares were listed on a stock exchange had to execute a listing agreement with the company, with the stock exchange. So there used to be a listing agreement between the stock exchange on one side and the company on the other side. And that was regulated by the stock exchange under the Securities Contract Regulation Act. Now, even under the old or the erstwhile listing agreement, approval of the stock exchange was required for the purposes of approving any schemes of amalgamation, mergers or demergers. What has happened subsequently? Effective from 1st of December 2015, the provisions of listing agreement has been done away with, and instead you have the provisions of SEBI LODR, in short, of 2015. So SEBI Listing Obligations and Disclosure Requirement Regulations 2015 come into play in case one of the entity is a listed entity. Now, what has changed under the LODR? Nothing has changed, except that you do require approval of the stock exchange. And the stock exchange can refer the matter or would refer the matter to SEBI. And SEBI would examine every aspect and thereafter grant the approval or grant what is known as the observation letter. And until you get the observation letter from the stock exchange, you will not be able to even move a bit. You will not be able to take a single step ahead in the entire exercise of amalgamation. I must apologize. I should have first taken for discussion as to what amalgamation means. Amalgamation would mean the transfer of the entire undertaking, the entire assets, all the liabilities, all the contracts, everything which a entity owns is transferred, and the words there are vested. It stands vested in the transferee entity, and the transferor entity is liquidated without being wound up. In other words, the entire undertaking or the business of the company is transferred to another entity. This is as far as amalgamation or merger is concerned. What happens in case of a demerger? There is this concept of demerger. Let me go back into corporate history, and I'm talking about sometime between 1980 to 1986. All of you may have heard about the business house in Delhi. This is something which is Nilesh, there is something which comes on the screen, which has come on the screen.
What?
Beauty may be something.
Beauty में I can't see anything.
મારા સ્ક્રીન ઉપર આવ્યું હતું હમણાં.
I can't see on my screen, so I don't know.
Okay, fine. Let's continue. Sometime you would have all heard of a group in Delhi known as the Shriram Group or the DCM Group. It was a large joint family of Lala Shriram or Lala, I forgot the patriarch's name. He had diversified business, and he had children and grandchildren and great-grandchildren. Obviously, when everybody joins business, everybody has different thoughts, different ways of doing business, different views, different opinions, etc., etc. So what happens? There are bound to be some or the other differences or disputes. And then one has to figure a way out as to how everybody is happy, does the business in a very peaceful and harmonious manner, and at the same time gets a fair share of the business. So in order to figure a way out whilst the disputes were going on, what did they do? They used the mechanism of 391 to 394 for the purpose of demerging or separating certain business into new entities or into newly incorporated entities with a mirror image shareholding, and then transfer the shareholding to the individuals or to the persons who will carry on that particular business. Just to explain in a very simple language, there is this company A. Say it has 4 business. It has business of textiles, it has business of shoes, it has business of machinery, and it is a real estate business. 4 different businesses, 4 different business verticals, large family, children, grandchildren, great-grandchildren, and each of the faction, 4 factions in the family, and 4 factions of the family wants to carry on 4 different businesses, each one to be given 1 faction of the business. So what do? You see where the assets are the maximum. You keep that particular entity in the existing entity. And you transfer, for example, the real estate, business vertical which is there, you keep in this company A, which is undergoing a restructuring exercise, and the textile business, the shoe business, and the machinery business is transferred to 3 new entities with mirror image shareholding of the company A, which had the consolidated business. So in other words, you could easily transfer the businesses with the same shareholding pattern or exactly the same shareholders and have 4 distinct different business verticals put into 4 different business entities. Now, this is in short a demerger mechanism whereby the assets and liabilities and the business are transferred at book value to another entity known as the resulting entity, and that particular business sits or is transferred to the resulting entity. The entity which is transferring the business is known as the demerged company, and the business and the entity where the business is being transferred is known as the resulting entity or the resulting company. So that was the advent of the schemes of demerger sometime in 1984, 85 or 86. Then there was a lull. There was a lull until 92, 93, where thereafter in 92, 93, all of us have heard of Mr. Vijay Mallya. Now, Vijay Mallya, we all know that he has the business of alcohol or beer or alcoholic drinks or alcoholic beverages. We didn't know, or rather very few of us may know, that he had a pharmaceutical business as well. He had engineering business as well. So there used to be a company known as Hex Limited, which had the business of pharmaceuticals and chemicals business, which was a joint venture between the UB Group on one side and Hex Uday Germany on the other side. And they had some other business which they wanted to which they wanted to transfer or separate. So what did they do? They used the mechanism of demerger under 391 to 394 for the purpose of separating these two businesses and thereafter transferring the shareholding in the resulting entity to the entity who wanted that particular business. Again, a listed entity, mirror image shareholding, transfer of the assets and liabilities at book value under 391 to 394 of the previous act and 230 to 232 or 240 of the new act, 2013. The substantive part of law remains the same, except for certain judicial precedents and the provisions of Competition Act and the provisions of SEBI Takeover Code. Everything else remains the same. Then came immediately sometime in 94, 95. I'm just touching upon these as examples for the purpose of ease of understanding this particular topic. There was this company which was known as Sandoz India Limited. And they also had the business of chemicals, specialty chemicals, which was essentially the business of pigments and business of master batches. Now, pigments, just to explain to you, is nothing but the color. The color which you see on plastics, the color which you see in automobiles, to put it in simple language. Sandoz was essentially a pharmaceutical or a life science company, whereas it had other business as well. It had to separate this business because worldwide, Sandoz had transferred the chemical business to another company known as Clariant AG Switzerland. So in other words, Clariant did not want the pharmaceutical business and Sandoz did not want the chemical business. The two shareholders had two different business ambitions and they had two business goals and therefore that had to be separated. How do you do that in India? With least possible tax implication, with least possible stamp duty implications, with least possible implications into then FERA, now FEMA, with least possible any other complications under Indian law. What did they do? Again, they resorted to 391 to 394, where the chemical business was transferred at book value to a company known as Clariant India Limited, which was formed specifically for this particular purpose. And since there was this mirror image shareholding, the stock exchange also granted approval for the purpose of listing the shares of Clariant India Limited without Clariant India Limited having to issue a prospectus for the purpose of listing the shares. As you are all aware that in case a businessman or a business entity has to get its shares listed on a stock exchange, it can do either by the schemes of arrangement or by issue of prospectus and offer the shares to public and thereafter list the shares. Now, obviously, if there is already a listed entity and you want to transfer the business and give the benefit to the shareholders, and the resulting entity also has to be listed, then under the Securities Contract Regulation Act of 1956, one has to seek an exemption under what is known as Rule 19(2)(b) of the Securities Contract Regulation Rules 1956. So, the stock exchange or SEBI will grant you the approval to get the shares listed without having the necessity to file a prospectus or an offer document with SEBI. So the shares of Clariant were listed. Even in case of DCM group of restructuring, the shares were listed. Exemption under Rule 19(2)(b) was obtained. In case of Hex and Hex Marriott Russell, again the same mechanism was adopted. Then came, I don't want to complicate by giving too many examples. I will come to substantive part of law as also procedural part of law in a minute or in a bit. Nilesh, we have time until what?
Yeah.
6 o'clock, ne?
30, don't worry.
Okay. So I will take the procedural aspect of the discussion today at around 6 o'clock because it's not very difficult, but at the same time extremely important, because if you don't have the blessings of NCLT, howsoever good, howsoever efficient, howsoever good looking your scheme of arrangement is, it is waste of time, money, energy. So then came in 96 or so, there were two entities, Hindustan Ciba Gaiky and the Sendos without the chemical business. Hindustan Ciba Gaiky had three businesses: your life science or pharmaceutical business, your specialty chemicals business, and the agrochemical business. Don't ask me as to why they had put all the three business in one entity. But be that as it may, Hindustan Ciba Gaiky had three businesses: pharmaceutical or life sciences, agrochemicals, and specialty chemicals. Worldwide, there was a company by the name of Novartis which was formed and which acquired the life science business of Ciba and Sendos in order to form Novartis. And the remaining business, it transferred to Ciba, again another entity in Basel, Switzerland. And as far as agrochemicals is concerned, they formed a new company known as Syngenta for the purpose of transferring that particular business, not only in Switzerland, but worldwide. For the sake of clarity, and because I may have explained to you in a little roundabout or a difficult manner, let me make again an attempt to make it simple. There were these two entities: Sendos, only life science or pharmaceutical business, and worldwide Ciba Gaiky, which had business of agrochemicals, pharmaceuticals, and specialty chemicals. It wanted to trifurcate these three businesses into three different entities so that the shareholders get a better value for each of these three businesses. So worldwide, they did this. Then came in India. India, there were two entities: Sendos India Limited, only life science or pharmaceutical business, no other businesses. And they had, agrochemical business as well. Because the chemicals, they had already transferred it to Clariant. And in Hindustan Ciba Gaiky, they had three businesses. So how do you see to it that they are put into three different entities? Again, what became handy was the schemes of mergers and demergers, the scheme of demerger. So what did we do? We transferred the entire life science business of Sendos and the agrochemical business of Sendos into Hindustan Ciba Gaiky and renamed the company as Novartis India Limited. At the same time, Hindustan Ciba Gaiky, we kept the agrochemical business there and there only. We did not transfer it to anybody, but we transferred the specialty chemical business to a new company known as Ciba Specialties Limited, formed specifically for these purposes and got the shares listed. So we could achieve separating the business in the first stage by keeping agrochemical and life sciences together, and we kept the specialty chemical business into a new company. The same mechanism when we transferred the chemical business of Sandoz into Clariant. And in stage 2, once the agrochemical business was in one entity, Novartis demerged the agrochemical entity after a year into a new company known as Syngenta India Limited. Again, no tax implications on the transferor entity, no tax implications on the transferee entity, no tax implications on the shareholders, because you got one free share of the resulting entity. And in case of a scheme of demerger, to put it in a simple language, what is it? It is just one piece of paper which has both the businesses. It's just broken up into two pieces and two different entities. So you have then holding the share, instead of in one entity, you are holding the shares in two entities. This is, in short, what is known as the scheme of demerger. Then the business houses started doing that very frequently because there were no tax implications. It was, except for the approval of the High Court from a regulation perspective, and of course the approval of the shareholders and creditors was necessary. There were no other complications. So they started doing that. And since it did escape tax, so the tax authorities started thinking on it as to how the hell are they doing this without any tax leakage. Let's look at it. So then they amended the Income Tax Act, okay, and brought in special provisions for the purpose of demerger only with effect from 1st of April 2000. So I'm talking about an era which was 96, where several schemes of amalgamation and mergers and rather demergers were done, which escaped the tax net, and only from 1st of April 2000, this particular provisions were brought in under the Income Tax Act.